Valuing a business that's in a high growth phase is really more art than science. Because your revenues and profitability have generally not stabilized, valuation methodologies that are used for more advanced businesses, such as discounted cash flow, don't really make sense here. So how do you value a startup or a scale-up business that's still growing? One way is to value your business based on a multiple of revenue, and to benchmark that multiple against those that have been used by comparable businesses in your sector who have also recently raised capital. By benchmarking your valuation against those of your peers, you're demonstrating to potential investors that the valuation is reasonable because it's based on valuations that have already been accepted by the market for similar companies. So how do you do that? First, you need to identify comparable businesses in your sector that have recently raised capital and the revenue multiples that were used on those transactions. The multiples used by each of the businesses in your sample group will vary depending upon the attributes of each business, and so you'll end up with a range of multiples. From there, you'll need to form a view about the attributes of your business compared to those in the sample group, and based on that analysis, decide which end of the valuation range is fair for your business. For example, if the valuations range from 5 times revenue to 10 times revenue, and the attributes of your business are just as strong as the best companies in that sample group, you'd be justified using a valuation that's closer to 10 times revenue. But if your business is not quite as developed as the higher performers in that group, adopting a revenue multiple at the lower end of the range would be more appropriate. When you apply that valuation methodology to your current and forecast revenue, it begins to tell a story about the potential valuation uplift between this round and the next. That'll sound something like this. Our valuation is based on a multiple of 5 times last year's gross revenue, and this revenue multiple is comparable to similar companies in our sector. On completion of our 12-month growth plan, we are forecasting annual gross revenue of $1 million. At that point, based on the same valuation methodology, we forecast our valuation to be $5 million, reflecting an uplift of X% for investors in this round. Now, for companies that are pre-revenue, or for which it's difficult to determine a fair valuation for any number of reasons, you may want to consider using a convertible note or a safe note. That allows you to raise capital now without having to set a valuation immediately. And for more complex pre-revenue companies, such as biotech companies and other R&D heavy companies, well, that's more than we can cover in this short video. Obviously, valuation methodology can be complex, and we haven't even really scratched the surface here. So if you need help setting your valuation, come and talk to us. Ultimately, your valuation should fairly reflect the value that you've built in your business so far, but be reasonable enough to recognize the risk involved in the next stage of growth and allow an uplift for investors that's commensurate with the risk they're taking now. To find out more, download the new capital raising manifesto on the VentureCrowd website or call us.